Right, can I welcome you all to lecture 8. I'm mic'd up this time. John, one of my Twitter chums, suggested that it might improve the sound quality if I mic'd myself up to my iPad, so I'm giving it a go and hope that you'll get a better sound experience, fingers crossed. Lecture 8 is actually the 4th lecture in terms of macroeconomics. So remember, the first lecture was all about how you would measure an economy. The second lecture introduced you to a couple of simple aggregate supply and aggregate demand diagrams that you could use to explain the difference between economists who think that more intervention is important in the economy and economists that think that less intervention is important in the economy. We then looked at some problems of imbalance and instability in the economy, with particular focus on inflation, which I described as not being good for the economy, and economic growth, which I described as being very good for the economy. Now, if you do feel that you can manage an economy, you have two main macroeconomic policies that you can use. And I'm going to talk about them in the next 2 lectures. So this lecture is about monetary policy, and the next lecture, 9, will be about fiscal policy. Together they make up what are called the demand management policies, and they are predicated on the idea that you can manipulate an economy to achieve a high level of employment. I'm not convinced, as you're probably beginning to realise, but that doesn't mean to say, of course, that I won't explain to you exactly what the thoughts are on these topics. So, the title of the lecture that I originally gave to go with this particular chapter in my book on monetary policy was Money, Money Supply, Money Creation, Monetary Demand, Monetary Policy, and Financial Stability. So in other words, we're going to look at money. I'll just explain what money is to you, because money is very confusing and lots of people at very high levels, even in central banks, don't quite understand what money is. So hopefully you will after this, because I'm going to give you a simple explanation of exactly what money is, then what the money supply is, how money creation takes place in this system, and how all of these combine to give you a level of monetary demand in your economy. And it's manipulating that monetary demand that is the monetary policy of a central bank, and also creating financial stability across the financial sector of the economy. So that's our title, and we're going to start by looking at exactly what money is. Now, F.A. Walker, who lived between 1848 and 1897, he defined money in a way which is the definitive definition of money as far as I'm concerned. He said, money, that which passes freely from hand to hand in full payment for goods in final discharge of indebtedness, being accepted equally without reference to the character or credit of the person tendering it, and without the intention on the part of the person receiving it to consume, enjoy, or otherwise use it than by passing it on sooner or later in exchange. Says it all. Right? It's that passes from one person to another in payment for goods and services. It's a final discharge of indebtedness because people accept it. That's the end of that debt situation. You accept it without any reference to who's giving it to you, their character or their credit. Money sits aside from all of those things, so you have no concern about who is giving you the money, you just have concern about the money itself. And the person who receives it, they don't enjoy it, they don't consume it, they don't use it in any way other than to pass it on to somebody else in exchange. That's what money is. Well done, F.A. Walker, for pointing that one out. Now, just talk very quickly through the older forms of money to the new forms of money, and there are lots of people who will disagree about this, and I've got a few stories on the way, some which may have a little bit of fiction in them, but the whole idea is to create in your mind a clear understanding of what money is. Now, if we go right the way back, as we have done in a previous lecture, to when we all lived in caves, we were subsistence, but there may be someone in the next cave to you who had something that you want, and there may be something in your cave that they want, and you may exchange. A system of barter, so you just swap things over from person to person. Now, the system of barter has problems. It does require a double coincidence of wants. That means if I've got something I want to get rid of, I've got to find someone who wants it and also has what I want. And it's very difficult to divide things up when in that process. So there are great disadvantages of having a barter system. So what happens in a barter system is something comes along which starts to take on the characteristics of money. For example, if I've got something that I want to exchange with somebody else, and what I'm giving them is more valuable, and we both agree it, than what they're giving me, then I might ask them to give me something additional that I don't want, but I know everyone wants this. It's a generally acceptable thing, and if I've got it, I can get rid of it and exchange it with other people. So lots of things sort of filled that category. It might be something, a commodity like salt. I might take a lot of salt in addition to whatever else I've exchanged, because I know I can get rid of that somewhere else. So salt takes on the qualities of money. And if you read the textbooks, there are loads of examples of commodities. If you go to Newfoundland, they use dried cod as money. If you go to the South Sea Islands, they use cowrie shells as money, not because they were particularly useful, but they had ornamental value. And lots of items like that would be used as money. That is, people would accept them, not because they want them, but they know they can get rid of them to somebody else in exchange. So the characteristic of all of these forms of money that were really commodities was that there were two characteristics. They had value in use. You could use cowrie shells as ornamental things. You could use dried cod as food. You could use salt as a preservative on food, etc. And they had a value in exchange, because I knew I could use them to exchange for something else. So these have two characteristics: value in use and value in exchange. So we've got monetary systems developing all over the place, despite the fact there are some economists who don't think that barter ever existed. There was always money, but we'll ignore that because it's fairly obvious that barter would have been a system that preceded money, and that money would have entered the system because it improves the way that people trade and exchange goods and services. Now, monetary metals became quite useful as money. Silver, gold, because they had value in use, but there were also things that were generally acceptable. People wanted to hold those sort of things. They held their value, so people used them as money, and they might just be pieces of, or they might have been minted into coins and made into small units. And the story I'll tell you now sort of picks up in the 16th, 17th century, but it does explain to you, hopefully clearly, how we move from a situation of money to money created and to a change in monetary demand. And from Europe, there were Jewish emigres. They were persecuted in various countries in Europe, who came to live in London, East End of London, City of London, that sort of area, and they were goldsmiths. Now, what goldsmiths were people who made jewellery and made things out of gold. And if you made things out of gold and precious stones and metals, you usually had to have a vault in which to hold your stock and protect yourself against someone who might want to come and rob you. Now, between 1641 and 1651, you had a civil war. And in that civil war, then people were not buying jewellery and ornamental knickknacks, but they were worried about their own surpluses of gold and resources that they may have. And so goldsmiths saw an opportunity to look after people's valuables. So they had a vault, and people would make deposits of valuables at goldsmiths. Goldsmiths would look after them and charge for the service. Now let us just assume, just to make this easy, that all that goldsmiths accepted was gold. So they looked after people's gold. Now when they looked after people's gold, they obviously gave those people a receipt to say, this is your gold, you own it, we're looking after it for you. So that receipt was just a piece of paper. Now if you wanted to go and use some of your gold to buy something, you've got two options. You can go and get the gold out, get it minted into smaller units, and pass it on to somebody else who then owns that gold and will probably go to another goldsmith and put it somewhere for safe keeping. Or you could just exchange ownership of those pieces of paper. So that I own this gold. If I buy this from you, I will transfer the ownership of gold to you, so I can endorse this bit of paper to say that you now own it. So pieces of paper start to be passed around in trade, and they were just basically the receipts that goldsmiths gave you for the gold that they were looking after. So paper receipts start to move around in the economy, and of course goldsmiths can see a little bit of a development of this business by saying, when you deposit some gold with us, we'll give you a range of paper receipts. You won't want just one. I'll give you one with a value of 5, another few with a value of 10, or value of 20, or value of 100. So you can see you've started the system of using paper money to trade, with paper money showing different denominations on it. At this point, there has been no money creation. Every piece of paper going around in the economy would add up to exactly the value of all the gold in the vaults. So we've got not a money creation situation, but we have money developed out of gold being deposited at goldsmiths. Now you can see here another opportunity, because as time goes by, goldsmiths find that people are using their receipts as money. These pieces of paper are being passed around, and very rarely do they actually want to come and get the gold. They have a right to, and some may, but basically there's a lot of gold sitting in their vaults which is never used, because trade is taking place between people using these goldsmiths' receipts. And there are always people who want to borrow money, particularly governments, and you've now got the beginnings of an early form of banking developing, where people will go to the goldsmiths to borrow some gold. Let's say government want to borrow some gold from a goldsmith, so they will make an arrangement temporarily to borrow some money, which is fine, because the goldsmith knows that that gold is there and it never gets taken out, or if ever taken out, only a small proportion of it. So it's quite safe to lend out some of that money and also charge interest, make an improvement in your profitability by now charging the government to borrow some of your gold. Now the government can borrow the gold for a period of time. It can take the gold out, or it could just accept a receipt of ownership of that gold, a temporary receipt of ownership of that gold. And of course it's much easier and convenient to pass around pieces of paper to people that people trust and are confident are backed by gold. And you started up, if you like, not goldsmiths depositories, but now goldsmith banks. And you've also created some new notes, some new money, because what you have is the original owners of this gold have got receipts, and so have the government have got receipts as well. So there are now more receipts in circulation than there is gold in the vaults. That is the beginning of money creation in the banking system. Now, there is always, under these circumstances, because you look at this and you go, this is a great way of making money, there's always a temptation to lend out too much. You have to be careful, because you've always got to have enough gold there for anyone who wants to take the gold out, for it to be there. If it wasn't there, then people lose confidence in that system and the system collapses. But you can make lots of money by increasing the amount of loans. So there are examples in the economic history textbooks about goldsmiths who went bankrupt because they overdid their loans to customers. Now, over time, the government sees an opportunity here to control money, and central banks develop. 1694, the Bank of England became the government's bank, and later on, 1844, they were given the rights, the only rights, the monopoly rights to supply currency and cash. So you now have a system which is basically called the gold standard, where there's a certain amount of gold at the central bank, and indeed in other banks as well, which is the foundation upon which notes are printed and circulated in the economy. Now, I said that when this system was private, there was a temptation to print too much, and even when it becomes public, managed by the government through its central bank, the temptation is still there to print too much. First real illustration of that was 1914-18, the First World War, where we were on a gold standard, which meant that anyone who had one of these Bank of England notes could take out the gold. That's why it says on notes, I promise to pay the bearer £5 of gold, £10 of gold. Of course, it doesn't mean that now, but it did then. So one of the ways, if you want to finance a war, you could borrow money, you could raise taxes, or you can just print it. That's a very quick way to have a war. But what happens during the First World War is a lot of money is printed to redirect resources into the war effort and buy things with notes that people have confidence in. But the excessive printing of notes creates World War I very high inflation. After World War I, the central bank, the Bank of England, or the Cunliffe Committee advised them that they should try and return to the pre-war rate of gold against notes, which meant, of course, fairly obviously, you've got to destroy lots of notes. So between 1918 and 1925, they destroyed lots of notes, and in 1925 they returned to the gold standard, didn't do it very well, so gave up completely on the gold standard in 1931. So what we had up until then was a model of money and money creation backed by gold. After 1931, when you go off the gold standard, then you have moved into a situation which is called a fiat currency, where these notes created by central banks and the Bank of England are in circulation and backed by nothing other than another note. So these are no longer commodity-backed IOUs. The fact it says I promise to pay the bearer £10 now means nothing except I can take my £10 note and I can exchange it at the Bank of England for another £10 note. So that's not an IOU, despite the fact that some economists, modern monetary theorists, think that currency, cash printed and minted by a central bank is an IOU. It isn't. It isn't debt. It is just money. Now, private money creation still carries on, but it's now managed by central banks. Central banks are taking control over the supply of money. They're the people who actually print the currency. although they don't have total control over money, because as we've said, there's money created apart from that. And in the old system, gold would have been the foundation upon which money is created. Now the new system, it's cash or currency, which becomes the basis upon which money is created. Now, as I'm trying to explain this to my students, we do a little bit of a, I suppose we can call this story time now. I ask my students, because we're located the university buildings in the City of London, very close to the Bank of England, and I suggest to my students, you might have walked past the Bank of England and you might have seen stuff being thrown out there, lots of paper and a few old machines, and you decide to help yourself to one of these machines and paper, because students always want paper, don't they, and they're always fascinated by machines, whether they work or not, and you take it home. And you find, of course, it doesn't work because the Bank of England was throwing it out. But you find it's got a plug, and you change the fuse in the plug, plug it in, and then it all bells and whistles happen, and your machine is working. And you pop a bit of paper through your machine, and you find out that you're actually producing legal, shall we say, £20 notes. And I say to them, what would you do? Which is obviously a bit of fun, because lots of people have lots of ideas about what they do. They print as much as they possibly could. They pay off their student grants. They go on holiday. They start their own investment portfolios. They have great ideas of what they can do. But there's also some people who won't do that. And they're actually the people who interest me. So the people who say, I'll take it back, I wouldn't do it, I'd throw it away, I wouldn't use it. That becomes interesting to me, because I start to talk to these people and try and persuade them that they should do it. And I explain that there would be good reasons for them to do this. For example, they could do charitable things with this money that they create. It could be their local football team. For me, Southend United are in need of a few players. I could perhaps run off some money and pay some salaries for new players for my football club. Carry on. So gradually I can talk people over to, yeah, all right, under those circumstances I might print money. But again, there's still some people who go, no, I definitely wouldn't print any money. And so I take them a little bit further, and something like, just imagine that your granny, who's nearly blind now, lives down the road in an old people's home where she's very happy, knows everyone, knows where you can visit her, the family can visit her and take her out, and it's a very happy place for her. But they're losing money, and they're going to move to 400 miles away to some other part of the country, because they're losing money, and all they need is £10,000 a week, and they could stay where they are. Under those circumstances, would you be tempted to print that £10,000 that would keep your granny in her home just down the road, where she knows everyone, knows everything, and has a wonderful time? And eventually they say, yeah, okay. So I can persuade everybody to print money if they've got a machine. And that's what you have to think about, because anyone, doesn't matter who it is, central bank, government, anyone who gets hold of a printing press can be persuaded to print too much money. And there are lots of economic theories which tell central banks, yeah, you can print money, there's no problem. We've got output gaps in the economy that could be closed if you expand monetary demand in the economy. We've got our good modern monetary theorists saying, yes, you can print as much money as you like. Your only limit is when you start to cause inflation. So, and as with the pandemic, you can see lots of money printed. A few days ago, just before this, the Bank of England said that it would print another £150 billion worth of notes to put in the economy to see us through the pandemic. I'll talk more about that a little bit later on. But as I say, I can persuade anybody to print money, and that's something that you should worry about when you're looking at money and money creation. Now, we do need to change or look at some distinctions between money and various things, because words are often misused and not used particularly precisely. And so we need to separate the idea of money and cash, or money and currency. The money that's used today to buy goods and services throughout the UK, about 95% of it isn't cash. It's checkbooks, it's credit cards, it's lines of credit, it's a tab down the pub, whatever it is. This is money because you're using it to buy goods and services, but it's not cash. Now, the actual amount of cash that you have in the system at the moment is probably less than 5% of the total amount of money that's being used, which means that 95% of it has been created over the years to create this system. So when you're talking about money, remember you're talking about 100% money. When you talk about cash or currency, you're talking about 5% or so of all the money in circulation is cash. Now, you do also need to distinguish between money and legal tender, because cash and legal tender are almost the same thing, not quite, because all the printed and minted stuff is legal tender in a certain number of units. Aggregates of coins are not legal tender, and this is basically to protect tradesmen from that person who has been saving 1p coins in a big jar, decides they want to buy something and takes it down to a shop and pours it all out and said, I'd like to buy that. That's not legal tender. The shopkeeper doesn't have to accept that. In fact, anything more than a pound's worth of 1p coins is not legal tender, although each individual coin is legal tender. So legal tender is what you can actually legally compel someone to accept as money in discharge of a debt. And cash and legal tender are almost identical, but for the fact that aggregates of cash are not legal tender, although every individual unit of cash is legal tender. Which means that the money that we've talked about, the 100% money, has two components to it. It has cash and it has credit, or bank created money. And I'll talk about them again in a minute. You have to separate those things in your mind. You're referring to one or other. You'll often find reference to money as liquid, and you find that there are reference to liquid and illiquid, or less liquid and more liquid. All that means is cash, currency, is a liquid asset. Things that you can change very quickly into money or cash are not totally liquid, but very liquid. And then if you move to other assets that you couldn't get rid of easily or quickly, they are very illiquid assets. They're things that can't be turned into money quickly. So you need to understand the idea of liquidity. The very liquid is money, is cash, and then if it takes a long time to turn something into money or cash, it's an illiquid asset. If it can be turned very quickly into money, then it's a very liquid asset. There's another one that's important within the banking sector that you must separate, and that is what's called the demand for money, and you separate it from the demand for loans. The demand for money is the demand for you to hold your own assets in liquid form. The demand for loans is the demand for you to borrow money from someone else. Now, sometimes you'll talk about people going to the bank to demand money, assuming they're not going in to rob the bank, they're going in for a loan. They talk about it as demanding money, but they're in fact demanding loans. They're not demanding money. And John Maynard Keynes pointed this out, that when you're demanding money, what you want is to hold your own assets in a form that you can use for transactions. As a precaution, it's money that you hold just in case you need it, or indeed it's speculative. There's a reason speculatively for holding liquid assets or money, and that is when you want to buy something, but you expect the price of it to fall in the future, so you hold on to the money in anticipation of the fall in price. which increases the value of that money. It's called the speculative demand for money. The speculative demand for money isn't savings, isn't putting it into other accounts. It's actually holding the cash, holding the currency, holding the money in anticipation that the price will fall in the future. In the old days, Christmas would be a time when you should be asking mum and dad for cash for Christmas, not a product, because you know, being an economist, that if you take cash at Christmas, you can use that cash after Christmas in the sales to buy more than you would have got if mum and dad gave you something. You're speculating with money. You're saying, I have the money because I know in January I can buy more things with that money than I will get now if you go out and buy it for me. Mum and dad get annoyed, don't they, because they like to buy you presents, but much better to have cash and speculate by holding that money and be able to buy more with it in the not too distant future. That's the demand for money. It's the demand to hold your own assets in a liquid form, in the form of cash. Demand for loans is wanting to borrow somebody else's assets, borrow somebody else's money. So they're two totally separate things. Don't confuse or misuse demand for money and demand for loans. And then I suppose we can put this, if you like, into a nice simple picture for you. Two concentric circles works very well to understand money. The money supply is cash in the middle, and then all the borrowing that was created by the bank, which we're going to call credit, on the outside. So the outside is 20 times bigger than the middle if the middle is 5% of cash. That's the money supply, and you could even measure it in a straightforward way. You could go to the Bank of England and say how much cash is out there. They give you a number. You can go to all the big banks and you can say, can you tell me the value of all your current accounts? You can add them all together and you get a number which we're going to represent by the big circle, and it will be supported in the middle by a base of money which we're going to call cash. We'll make it nice and easy, and our money is going to be just cash and credit. Now that's the money supply, and it's a static concept. It's one point in time. I can measure it. I can say this is the number. That's the money supply. Now it isn't monetary demand, because monetary demand is how quickly you pass on this money from person to person. So monetary demand is that money going round and round. So monetary demand is the money supply and the speed at which it's passed on from person to person. So in other words, monetary demand could grow just because people are passing on money more quickly to each other, or it could slow down. They're passing it on less quickly. So during the current pandemic, the speed at which people pass on money slowed down. During the likely coming inflation, people will start passing on money much more quickly because it's losing its value. People hold on to money when it's increasing in value. You've got deflation, but get rid of it more quickly when you've got inflation and that money is falling in value. So that's what monetary demand is. It's the base money, which we're referring to in this case here as cash. Remember, in the old days it would have been gold at the base, and the outside circle would still be goldsmiths as banks lending money. Now the bit in the middle is cash and the outside is credit. So we have what's called a fiat currency backed by nothing other than these pieces of paper that the Bank of England guarantees have value, but that value can quickly be reduced when you have inflation. Now, if you go back in sort of 50 years, then there was quite a nice, simple relationship. The amount of money in the system was related to the amount of cash in the system. So much so that if you go to the 1960s, there was a cash ratio. The Bank of England said that all banks must hold at least 8% of the loans that they have created, the assets that they have. They must hold it at the bank in cash. Now cash ratios have gone, it's led to quite a lot of economists to ignore this or poo-poo the idea of a multiplier in the economy. But of course, not a strict relationship, but it's still there, because you require all your banks to hold a certain amount of cash, because you go to cash machines, ATMs, and take out cash. And when you go and take out cash, you wouldn't accept a cheque coming out. You are asking for cash to come out, that is notes to come out. And banks will have to be careful that they don't discourage you or you lose confidence in them because you go to a cash machine and it says, sorry, you can't have your cash back. So there is still a base that banks work with, that they have to have a certain amount of cash available. Now, in the old days, it was easy. Now it's still there, although there are economists who argue about this, and that is that there is a multiplier relationship between the amount of cash in the middle and the size of the outside. It is what's called the bank credit multiplier, and it's 1 over that cash ratio. So if the bank requires to hold 10% of all of its assets in cash, then there will be a multiplier of 1 over the ratio, which is 10 over 100. How many tenths are there in 1? Well, there are 10 of them, which means that the multiplier is 10, which means for every change in the cash base, the inner circle, the outer circle will change by 10 times that change. It's a relatively simple concept, and we'll try and illustrate it for you with some numbers. If you just assumed, it would be nice and easy if there was just one main bank in the country and just lots and lots of branches, and everyone was quite happy to use cheques and credit cards, and no one ever wanted any additional cash than the cash they currently hold, so there was never any cash drain to the public. Then under those circumstances, suppose banks wanted to keep 5% of all of their assets in cash. How much would the outside change if the inside changed? Well, it's 1 over the ratio, so it's 1 over 5 over 100, which is 1 over a 20th. How many 20ths in 1? 20. The multiplier value of a change in currency or cash in the system would be a 20-fold increase in money. We've just said if it's 10%, it would be 1 over 10 over 100, so the multiplier would be 10. If banks wanted to hold 20% of all of their assets in the form of cash, then it will be 1 over 20 over 100. 20 over 100 is a fifth. How many fifths in 1? 5. So the multiplier then would be 5. Now what that means is, let's see if we can go back to this diagram here just to illustrate this point, that if banks want to hold 5% at the base, and the base increases by, say, 1 million, the outside will increase by 20 million, but the amount of bank lending, the credit that's created on that base, will just be 19. So change in the base of 1 means a change in bank lending of 19. 19 and 1 is 20. That's the overall effect. If we went to the other extreme, if that cash in the middle was 20%, it would be 1 over 20 over 100, 1 over a fifth, multiplier would be 5. So if I change the middle by 1, the outside would change by 5, but the credit bit, the bank lending bit, would only change by 4. So the multiplier value depends upon how much cash or currency banks want to hold against all of the assets that they have created or issued. Now, we'll talk a little bit more about that when we really get round to looking at monetary policy. But before we do that, I'm just going to introduce to you what the rate of interest is, the price of money. There are lots of theories of the rate of interest, and I'm just going to go quickly through them so that you're clear on what they are, and then explain to you that they're not quite as useful as they seem. There's a liquidity preference theory of interest rate determination, which is a Keynesian interest rate determination model, which is the supply and demand for money. Now remember, that's different from the supply and demand for loans. We've already separated those things. This is the supply and demand for money. So that demand for money curve just slopes downward from left to right, because when the rate of interest is high, you want to hold less money and more assets. When the rate of interest is low, you tend not to worry too much. You hold more money and you hold less assets. And there is at the bottom there, it says the trap, what Keynes called the liquidity trap, that there's a point at which if interest rates are so low, a little bit like now, then you would become indifferent. I'm not worried whether I hold cash or whether I turn it into a savings deposit or something else, because the rate of interest is so low that I'm just indifferent. So that's the demand curve, and the supply curve is determined by the central bank. So if the central bank have supplied a quantity of money to the economy, which is Q1, then you create an equilibrium at interest rate 1, so that quantity creates an interest rate at R1. If we go to Bank of England increases the amount of money in the economy, as they have done at the moment, with 150 billion pounds worth of asset purchases, the supply curve shifts to the right, and the rate of interest falls to a lower level. So that's the sort of Keynesian, is what's called liquidity preference theory. People's preference for holding money will determine the rate of interest. So that's what Keynes said. Now, if you look at it from the point of view of the bankers, we talk about a loanable funds theory, which determines interest rates, which looks more like the supply and demand curves that we're used to, because here what you're saying is, as the rate of interest goes up, people will supply more money more money into accounts for savings accounts. But as the rate of interest goes up, less people actually want to borrow it to do things with it. If the rate of interest goes down, more people will want to borrow, but less people will want to save. So we've got our nice equilibrium, haven't we, where the supply of savings equals the demand for loans, and any rate of interest which is not like that will create a disequilibrium between those two numbers. A higher rate of interest will mean more savings but less demand for those loans, whereas a lower rate of interest will mean less savings and greater demand for those loans. So there's that, remember the arrows that sort of push you back towards the middle, things tending towards balance, tending towards equilibriums over time. So there's a loanable funds theory of interest. And then there was a fellow, John Hicks, who put both of those together, and he said the rate of interest is determined on an ISLM model, where IS is equivalent of savings and borrowings, it's savings and investment, and LM is the same as supply and demand for money, where L is liquidity preference demand for money, M is the supply of money. But here it's different. On the horizontal axis here, you haven't got a quantity of money, you've got the national income, or in this case here, the real gross domestic product. Some measure of the output of the economy is along that axis there. And what Hicks was saying, if we put these both together, so that we haven't got two theories, now we've just got one theory of interest rate determination, is that as the rate of interest goes up, so the point at which supply and demand for money will be equal is at a level to the upward sloping to the right. If investment and saving, it's the other way. So as the rate of interest goes down, so the point at which investments will equal savings is at a higher level of national income, not a lower level of national income. So in other words, as national income rises over time, so interest rates will tend to fall as far as investment and savings are concerned, and rise as far as supply and demand for money are concerned. Where they cross is another nice equilibrium. Now, having got those three ideas of interest rate determination, it shouldn't lead you into a conclusion that there is just one central rate of interest and it's the same rate of interest for everything, because it isn't. And what we have is what's called a structure of interest rates. So that's lots of different interest rates there isn't just one rate. So the Bank of England's bank rate is considered to be something that underpins other rates. I would rather say it distorts other rates rather than underpins them. The structure of interest rates, if we're talking, well, let's put it there. The structure of interest rates is based upon the RAT. The RAT, RAT, is the risk that you're taking when you lend money or you save money. It's the amount that you're saving or borrowing, and it's the period of time, the term over which you're saving and borrowing. So if you looked in the economy now, you wouldn't see one rate of interest. You'll see a whole structure of interest rates. Savings rates, you'll probably see a massive range of savings rates in various banks between about 0.1% or even less and 1%. So it's not a big range for savings, is it? But loans, you could probably borrow at around 2%, even slightly less, for a mortgage for a fixed period of time. Or you could get a payday loan and it would be the equivalent of, say, a rate of interest of 3,000%. So really big differences between those two extremes. And when the Bank of England adjusts bank rate, what it tends to do is just affect the secured end, where there's low risk, can be large amounts and long terms, but where the risk is very low. But it doesn't affect other rates that much, despite the fact that textbooks talk about a transmission mechanism. It doesn't transmit through the whole spectrum of interest rates. It just has an impact upon the lower end or the secured end of borrowing and saving. Those are the rates that tend to go down when bank rate goes down, or up when bank rate goes up. So don't think only about interest rates being determined by one theory or a couple of theories put together in a hybrid form by John Hicks. There are lots of different interest rates out there in the market. So there is a structure to interest rates, which means that some areas interest rates will be very low, other areas they will be very high, and that's an important thing to understand. Now, hopefully it's been a bit quick, I know, but we now know what money is. We know what the money supply is. It's now all the cash in the system and all the current accounts in the banks. And we know that the speed it goes round, its velocity of movement, determines monetary demand at any one point in the economy. So we now have the conditions to manage an economy, and monetary policy is a central bank managing the level of monetary demand in the economy to create whatever its target is. Monetary stability at the moment, it's inflation of 2% is its target. So it wants to manipulate the money supply and the speed it goes round to create a stable level of monetary demand. So it's usually referred to as the central bank has two levers that it can work on. One is interest rates, the price of money. It can put the price of money up and down to discourage loans or encourage loans, expand or contract the money supply as it sees fit. Or it can just put some more money into the economy, as QE has just done, so it can change the quantity of money. The rate of interest in this context is often referred to as the price of money. It changes the price of money or the quantity of money. And another thing which I'll mention is that it also maintains the liquidity of that money. It need not necessarily change the quantity, but it changes the liquidity of that money by making more cash available at certain times of the year and less cash available at other times of the year when it's not required. So monetary policy is just managing the aggregate level of demand in the economy by making adjustments to the price of money and the quantity of money. When we look at fiscal policy, then we have a definition that's almost the same. Fiscal policy is managing the aggregate level of monetary demand in the economy, but here the levers are different. It's tax rates, it's borrowing, and it's government spending. And you never want to confuse those things. That's why we talk about fiscal policy and monetary policy separately, so you can understand there's different. There are some similarities between them, and one does affect the other, but if we understand what they are separately, life will be a lot easier when you try and understand economics as a whole. So monetary policy is managing the aggregate level of monetary demand. Now, the Bank of England does have total control over the quantity of cash in the monetary system because it's responsible for minting it and printing it. Admittedly, there's counterfeiting, but let's forget that. So it controls cash. It has much less control over what banks can lend. So if you like, the 95% that's been created out there, it has much less control over, and it has even less control over the speed that we use that money. I've even heard central bankers say, come on, go out and spend money. We want you to, I suppose even Rishi Sunak's eat out to improve the economy. I forget what it was called now, but that was an attempt to try and get you to spend more money. So they do try and affect the velocity of circulation in the economy, but really the Bank of England can do nothing. The only thing they can really control very precisely is the amount of cash in the system, but that's not a particularly large part of the system. If we go back to, let's find one of our previous diagrams just to illustrate this point. You remember just our two concentric circles. In the middle, that's cash. Now that cash can be affected by the Bank of England. They can use quantitative easing. They could use quantitative tightening. I'll explain the difference between those in a minute, but they don't. And they can do something to affect the liquidity in the system, which is called an open market operation. So OMOs and QE can affect the amount of cash in the middle. Interest rates, or the price of money, are there to affect the outside, if you like. That's to encourage more borrowing or discourage borrowing. So a monetary policy targeting the outside would use interest rates. Targeting things from the middle would use a quantity concept like quantitative easing or open market operations. Now the reality, of course, there was debate back in the 1980s. Part of that time I was involved in this debate where the Bank of England was trying to decide whether or not it was better to use interest rates or quantitative money controls, and they basically decided it was interest rates and ignored quantitative money controls until recently, as we know. So interest rate policy was the way to try and adjust the outside of the money supply, that total number. And when the Bank of England became independent in 1997, then it really concentrated on interest rates to manage broad money aggregates. We have had bank rate as high as 14.875%, which meant that mortgages were about 17%. And that happened in 1989. In fact, in October the 6th, 1989, we had people very annoyed about how much they were having to pay on their mortgage. Just think now, if you've borrowed a nice big mortgage at 1.9% or 2.5%, how much you'd have to pay back if bank rate went up to 14.875% again and mortgage rates went up to 17 or 18%. No, you don't really want to think about that, do you? Until the financial crisis of 2007, we've never really had bank rate below 5%, not in the UK. But after the financial crisis, the bank became worried about deflation and wanted to try and boost borrowing, and it lowered rates from what were 5.5% down to 0.5%. And it's been stuck around there ever since, hasn't it? It's been down to 0.25, then back up to 0.5, and then back up to 0.75, and now with COVID, all the way down to a new low of 0.1. So bank rate, you can see, is still the prime focus of a central bank when it's trying to adjust rates up and down. Now, I did say that bank rate doesn't actually affect all interest rates in the economy, and you've got to take that into account. It doesn't affect all interest rates in the economy. It only really affects the secured end of the market. So when bank rate is very low now, you'll find mortgages are very low, but you won't find many other things are very low. Thanks to one of my students, Leisha, who did her dissertation on this very point, looking at the different interest rates, and she actually found out that credit card rates now are higher than they were before the global financial crisis. So our good old falling bank rate has had no effect whatsoever on credit card rates. And it is important to realise that the only real relationship that there is between interest rates and what's going on in the economy is that inverse relationship between interest rates and asset prices. Because as interest rates go down, then you can't make money in your savings, you tend to move towards investments, you tend to buy into assets which have, remember you read the small print, these things can go up or down in value. You buy into assets and there is an inverse relationship. If interest rates fall, asset prices go up. This is why stock markets are so high at the moment, not because the economies around the world are any good, but because interest rates are so low. So they often, if you go for distortedly low interest rates, you create speculative bubbles. You create asset prices, house prices, which are higher than they would be if interest rates were normal, around 5%, and exactly the same for stock markets. So I'm not a great fan of using interest rates. I would like the Bank of England to use its quantity controls rather than its price controls to manage the economy. And indeed, after 2007, when we had the global financial crisis, by 2009 we'd reached this very low rate of 0.5% for the rate of interest, bank rate. And that rate was not encouraging banks to lend, or people to borrow from banks more precisely. So there was a concern that this might lead to some form of deflation. So this was then the time that the bank actually said, okay, time to create quantity of money. And that's where the bank started what they call their asset purchasing program. And they will insist that it's not money printing, but it's a bit convoluted to explain, but let me assure you, it's money printing. When all quantitative easing does is buy back existing debt, existing government. It could be any debt, but in the UK, it buys back government debt, which is already in the economy and in circulation. It's being bought by you and me. It buys that back in the marketplace, and it pays for it by printing money or creating base money. It likes to think of it as electronic money, but it's exactly the same as cash. It's 100% backed by cash. And we had up to £445 billion worth of quantitative easing, which took place after the global financial crisis, and it did support inflation. It did avoid deflation. And now with the pandemic, we've added another 200 billion, and then another 100 billion, and then another 150 billion, so that we've now got £895 billion worth of units of cash, money printed in the economy, with probably more to come. So it's that cash base now which is taking over as the way of trying to boost monetary demand in the economy by pumping cash into the system through a quantitative easing process. Now, quantitative money, there are several terms you have. Quantitative easing is nice, easy to understand. Quantitative easing just means you buy assets and print money with it. You can reverse that process, which will be quantitative tightening, which means that the bank would be holding government debt that it's bought with printed money. It could sell it back into the market and take some cash out of the market. So it could manage the quantity by a quantitative easing program or a quantitative tightening program. Also underneath all of this, there is open market operations going on, where open market operations is exactly the same as QE and QT, but it's designed to maintain the right level of liquidity in the banking system. For example, perhaps not this year, but when we come up to Christmas, people want a lot more cash. So the bank can return cash to the system through open market operations by buying up some of the government debt. At the time at which self-employed pay tax, there's an increased demand for cash. It can do the same then. And then other times during the year when there's less demand for cash, it can take it out by reversing that process, which means selling that debt back into the economy and taking the cash out. So technically we've got QE, QT and OMOs are in there to change and affect the quantity of money in the economy. Now, you may like to take breaks, of course, when you're listening to this, because this one is just go on a little bit longer, but there's some very important things here that I want to keep all together so that we have no problems. And I am a great fan, as you know, of the less interventionist school of thought in economics, and that means that I would be classed as a monetarist. So let me explain to you exactly what monetarism is, because most people who poo-poo monetarism don't actually know what it is, and I'll illustrate it to you just using the Irving Fisher's quantity theory of money equation. There are lots of different equations which are made very complicated and difficult to understand, as economists like to make things difficult to understand, but it's really quite easy. It's a money supply number. We've identified what the money supply is, times the speed it goes round in the economy, the velocity of circulation of money, is equal to P, which is the average price level in the economy, and T, the number of transactions in the economy. Now you can actually think of M times V together as monetary demand. As we have said, it's monetary demand, the supply and the speed that it goes round in the economy. And you can think of P times T as some sort of aggregate for national income or national output in the economy. So what you're saying is there is this relationship in the economy. And therefore, if I change these variables, then something will happen. For example, if I increased M, which is currently happening with the Bank of England, their quantitative easing program, they're changing M. Now, if M increased and V slowed, which is what's going on at the moment, it might not change P times T. If M increases and, say, causes some inflation and people start to get their money more quickly, so M goes up and V goes up, then something's got to happen on the other side. The average price level has got to go up, or the number of transactions have got to go up. And if you're a Keynesian economist, you say, well, it's the number of transactions that go up because we've got spare capacity in the economy. If you're a little bit like me, you say, no, it's not likely that that will be the case. It's more likely that the average price level will go up because spare capacity tends to sort itself out, you know, at the natural level of employment and unemployment. You remember that concept. So for me, what happens on the M and V side generally filters through to what happens on the other side for prices, or that component of national income, which is the nominal component or the price component. So that when you're talking about monetary policy, you're not talking about monetarism. And quite often there are people who go, monetarism is useless, isn't it? Just look at what this has done. And you go, no, what that is monetary policy. That's nothing to do with monetarism. Monetarism is a way of telling you what to do with your monetary policy, not what your monetary policy is. And what monetarists want is for monetary demand to be expanded just a little bit faster than the growth and the expected growth of output, and that will achieve your inflation target of 2% or keep prices low and stable, which is considered by the sort of less interventionist economists to be the optimum conditions for a capitalist free market economy to work. Now let me say just a little more about the current situation. I know you'll be watching this in 10 years' time, in 20 years' time, in 50 years' time, and you'll go, what on earth is a pandemic? Because hopefully we will have forgotten all about it. But at the moment, we have a coronavirus pandemic that's causing lockdowns and changes in the economy. And if we look at M and V, what is happening at the moment is central banks' activities around the world are boosting M considerably. So the money supply is being expanded very rapidly. Lockdown means you have less opportunity to spend money. So that is slowing the velocity of circulation in the economy. So the effect of a higher M and a lower V is really indifferent as far as inflation and deflation is concerned, because these two cancel each other out. So we could get a little bit of inflation in the near term. We could get a little bit of deflation in the near term. What we can almost say with certainty as monetarists is that we are going to get inflation, because as soon as you return to normal with an increased money stock and people start spending money normally as they did before, velocity will speed up again, and M times V will expand monetary demand and cause a longer term inflation problem in the UK. And if we have destroyed much of our free market private capitalist system, then we are going to be in for a period of stagflation, which means high unemployment and inflation together. You remember the very thing that couldn't happen if you believed in the Phillips curve, but we don't, do we? So we know from the 1970s it happens, and it will happen again now, that probably within, remember there are time lags always within monetary changes. So if I change the money supply now, the final impact on the economy won't happen for another 12 to 18 months or even up to 2 years, depending upon the starting position, or whether there are holdbacks through lockdowns or whatever it may be. But eventually we will get that inflation filtering through into the economy when we return to some form of normality. So the pandemic and monetary demand, the effect on monetary demand of the pandemic is indifferent. M has gone up, V slowed down, but the long-term effect will be inflationary, and if we have high unemployment as well, then we have what's called stagflationary. Now, a few more words on what's going on at the moment. If you think of yourself as a monetarist, you're not quite happy with what's been going on, because interest rates don't seem to work, and in fact there are some monetarists like myself who've argued they should never have been used. Quantity does work, so if you just pump more money into the economy, the effect will be, if it's faster than the rate of growth of output, it'll be inflation. So when we started the QE program after the global financial crisis, then inflation in the UK rose to 6.4% on RPI, 5.2% if you made it a CPI measure. We moved into a large current account deficit on the balance of payments and a much weaker currency, which depreciated by about 40% over that period of time. In other words, we overdid it. Now, talking to people at the Bank of England, they said we had no idea what amount of currency we had to put into the economy to avoid deflation, so we put in a number. We picked it out of a hat. They didn't quite say that, but they put in too much, which caused 6% inflation. but better from their point of view to put in too much rather than too little. So that's why you had a situation of higher inflation after the global financial crisis, and why you're likely to get more inflation now after the global pandemic crisis. If you're not a monetarist, if you're a Keynesian or you're a modern monetary theorist, or you're someone on the interventionist side of things, you will want monetary policy to be more actionary. It's part of a process for doing things. That is, if you feel that you've got output gaps in the economy that can be closed, you will want to use your demand management policies to do it. And although you might want to use fiscal policy, you will need an accommodating monetary policy. If I'm expanding things fiscally, remember I'll explain it to you next week, I'll want an accommodating expansion in money at the same time, low interest rates and money growth. And you will always hear a lot of critics who come from that school of thought saying, no, we haven't had enough. When things don't happen as they should happen, we need more of it. And it is the case now that there'll be plenty of economists who say, don't worry about pumping loads of money into the economy, don't worry about low interest rates. We've got so much slack in the economy that we need all this additional money in the economy. And then in a couple of years' time, when inflation starts, oh, don't worry about that, that's just cost push inflation. It's not that there's too much demand in the economy, it's that costs are rising. Although just remember, I've told you that every single inflation there ever has been is because there's too much demand in the economy. Remember, inflation is more units of money used in the same number of transactions, but that goes back a lecture, doesn't it? So the bank's in a very difficult situation at the moment, the Bank of England, just as a final word, because it put interest rates down very low as an emergency. So by 2009, that was an emergency rate that would be returned to normality, around 5%, a bank rate of around 5%. But things never worked out as the bank hoped, and there's always been an excuse for keeping interest rates low. So much so that people have got the idea that interest rates at the bottom end, the secured end, are almost going to be near zero. So they've borrowed more money than they should have borrowed to buy property. And now the central bank is frightened that if it starts to put interest rates up, it's going to bankrupt quite a lot of people who won't be able to afford the mortgages on the money that they have borrowed. So I'm all against interest rates being used as a policy, and I would like to get back to normality as far as interest rates are concerned as soon as possible. The Bank of England has got itself into a very difficult position that it can only get out of by causing asset prices to fall into the future. Whether it'll ever be brave enough to do that, I have no idea. Now, a lot of things that I've said here are quite controversial, and so don't take just my word for a lot of what I said. Do listen to other people, argue with other people. If you want more detail on some of the things that I said, you can look on my blog, which is jbhearn.wordpress.com, because on there are lots of articles about money, interest rates, understanding QE, how to set out the right monetary policy, and lots also about the next 2 weeks that we will be talking about in lectures 9 and 10. So lecture 9 will be about fiscal policy and how that should work in the economy. And I'm not a great fan of fiscal policy, so I will have to tell you about it, even though I don't agree that it works, but I will explain to you the theories behind using fiscal policy. And then finally, the last lecture 10 will be about international economics and how one economy relates to another. Sorry I've gone on a little bit. As I say, take breaks as you go through this. Take it slowly. I hope you've enjoyed it and it's made you think, and it will generate some more understanding within the overall context of what we've been talking about for all of this introduction to economics, and I'll see you lecture 9 soon.